Initially, I would like to talk a little bit about a few things. Notice that this chart is the NASDAQ 100 index adjusted by money supply. Um, and the whole idea of this chart is to show, yes, we're kind of living in this banana republic environment where things have been going up drastically in prices, but we're not seeing, the real moving fundamentals is really driven by dilution of money. Um, and I see a lot of people that tend to be very bullish in equity markets because they see that. But I think ultimately it's going to drive the cost of capital higher with inflation actually being higher for longer, and that will readjust the valuations of especially equity markets. But the idea of this chart is really, actually, if you go back to the 1940s, I was reading an IMF paper yesterday in which it was basically trying to explain what happened during the 1940s when we really build up those levels of debt that we had during the World War II, and how do we deleverage? And a lot of people like to talk about the inflation story. Inflation was a big part of it, running the economy hotter than historical standards was one of the main things that caused inflation to, or I should say, to the deleveraging process to unfold. But there was another thing, or another two things that happened during that period that I think often people forget about. There was a pegging, the pegging of the 10-year yields and other yields as well. We had it capped until I think it was a 2.5%. But one more thing allowed the government to actually cap those yields. One of them was the fact that we were in a much more disciplinary world back in those days, particularly when you look at gold being pegged relative to the dollar being pegged relative to gold. But the second important thing, which this paper was all about, it was really explaining how the government was running a primary budget surplus during that decade, in which helped the government to really, I'm referring to the post-World War II era, which really helped the government to reduce the amount of leverage over time. A primary budget is just looking at the actual spending by the government that excludes interest payments, if you're not aware of. And so today, given the environment we're in, I mean, we're not in a post-war era. I think we're at the beginning of a deglobalized environment. And it's not the very beginning. I think the beginning was in 2016, 2017, arguably, with the US-China tensions that used to be mostly actually Trump's idea that kind of translating to becoming something very bipartisan. And now it's got really, I would say, escalated into Russia and in Ukraine. You've got what's happening in the Middle East and even Guyana and Venezuela and so forth. There's so many different, geopolitical risk actually being, I would say, really spreading across the globe. But the real point of that idea is that in today's environment of actually entering a deglobalized environment and this need for reshoring and reducing this reliance that we have currently with imports and other things is really going to be driving more and more this fiscal dominance. How do we run a primary budget surplus in a world that strongly requires a fiscal dominance environment? It's going to be kind of mind-boggling to me. Let's go to the next chart. This chart is also really interesting. It's basically looking at this new regime that I think I've actually I don't get a lot of questions. I'm not saying I get a lot of people asking me stuff, but I did have a few people ask me a question that I think it's really important. They're talking about the gold correlation versus the 10-year yield. Now, a lot of people thought that gold would never rise with 10-year yields rising. That was an impossible scenario. And others would say, no, it's not nominal rates. You got to look at real rates. And even in that basis, things have diverged, I would say significantly. And the real question is, are we in the same macro regime we're in back in 2-3 decades ago? Are we entering something different? This chart is another example of that. It's basically showing you that the U.S. equity markets volatility is today highly linked to inflation expectations. If you look at and I'm measuring this by looking at the 10-year break-even rate, and you can see that the rolling correlation over the last year, and I'm looking at the weekly changes of that measurement, you can see that we're at the highest level we've ever been in terms of equity volatility inflation expectation. And what does that mean? That means that if inflation expectations begin to increase for many reasons that Kevin was referring to, in which we're going to touch here in this presentation as well. Most likely that's going to drive the volatility for equity markets. Most likely that's going to drive the prior chart, that is NASDAQ 100 relative to M2 money supply, to probably also decline over time too. And so that volatility today is a concept that I don't think is fully understood by market participants. Let's go to the next chart. Here's another new chart. Money market funds is one of the main bullish cases for the equity markets today. A lot of people like to talk about that there's a lot of money in the sidelines that could potentially drive equity markets even higher. And that is undeniable. The chart is right here. There's $6 trillion sitting on money market funds. So, Tavi, why are you bearish on NASDAQ and S&P 500? Or Kevin, why are you bearish? Because there's so much money on the sidelines. Well, like anything else in markets, I don't think we should ever be looking at things on a nominal terms. Let's go to the next chart. If you look at money market funds relative to total equity market, the size of the total of the equity markets in the U.S., you're going to see that it represents about 13% of the overall market. Well, back in prior bottoms, when we had a lot of money in the sidelines, because of the selling pressure that was caused, that then drove valuations to be depressed. In 2009, March of 2009 was the very bottom of the equity markets during that period. And 2002, I believe, was the very bottom for the tech bust. And you can see here, we're nowhere close to those levels. In fact, in the tech bubble, or the bust that was even lower peak, as you can see in this chart, it was somewhere close to 30% of how much money market funds represented of the total equity market size. And today we're about 13%. So I'm not sure. I don't think all money market funds will actually come into this to equity markets. In fact, historically, all the way back to the 90s, we've never seen money market funds run too much below 10%. So maybe we go back to the very low levels, which was 10%. There's 3 percentage points then of a potential upside. Is that really the bull case for equity markets? If that's the case, I would be very skeptical about that thesis. Let's go to the next chart. This next chart makes the same comparison, but instead of looking at relative to the size of the equity market, now we're looking at the size of money supply. How much money and credit is available out there? And is money market funds that much representative of what it is out there? And clearly, as you can see today, we are at historical lows too. Compared to other bottoms that we had in equity markets, we were somewhere close to 50%, 45% or so of the money supply was represented by money market funds. Today, we're about half of that. In fact, we're actually going even lower than prior times because of this movement in money market funds, or we should say in the size of money supply increasing recently, in which has caused this ratio to decline as well. But nonetheless, this is just another way to show that this overwhelming bullishness and all these narratives that people create sometimes is not really driven by the data or supported by the data. And that's my role here in this case, is just to show you that the data is really not supportive of that idea that there's a lot of money in the sidelines. So let's go to the next chart. So next time somebody sends you a chart like that, show them this chart, because I think that's much more a much better way to represent this data. Well, let's go to the next chart because I already showed this chart. Here's another thing that is going on in the global, or I should say in the U.S. economy, but also in the global economy. And you can see this in China, you can see this in Europe, but really in the U.S. it has the best data, more accurate data for us to measure this. It's basically looking at commercial loans, commercial and industrial loans in the U.S. banks. And today, the U.S. banks some of the U.S. banks put out results, and we're seeing some of the negative volatility in those names. But more importantly, we know that the banks are not lending money like they used to. And you can see this by this measurement. We've been going sideways. There hasn't been much of a lending growth in commercial and industrial loans. And this is not a very bullish sign. As you can see here, back in 2017 or so, we went through that period as well, a very extended period of no lending growth that actually led to what happened in 2018, the Volmageddon, a very turbulent year for equity markets. The economy had a lot of issues too. you can see the same thing happen in 2019 before the COVID crash and the COVID recession that actually caused the banks through the governments in stimulative packages and policies really caused this number to really spike up. Now, recently, since the regional banking crisis, we haven't seen much lending growth. And I think this is actually quite problematic for the overall economy. Let's go to the next chart. And so now we're looking at small caps, just another ratio. We looked at NASDAQ relative to money supply. Here's just another way to see the same level of frothiness in markets overall. Small caps relative to NASDAQ. I mean, at Crescat, we believe there's a lot of value in small caps, particularly metals and mining names, in which we tend to focus a lot more. But certainly, if you looked at from this perspective, we are seeing this I would say, performance from NASDAQ relative to small caps that we haven't seen in many decades potentially. This chart only goes back to 1990s, but you can see here we're now below the levels we saw back in the tech bubble. That was a time when investors should be starting to allocate capital towards small caps relative to NASDAQ, although small caps also got crushed during some small caps got crushed during that environment during the tech bust. It was actually a part of the market that outperformed technology companies and also NASDAQ 100. And so, to me, it wouldn't surprise me if we're approaching a bottom. That's really the idea of this chart, is to think about historically when we see these types of divergences, or I should say not divergence, but of things getting really wacky historically. Usually we're near a big shift in allocations, and wouldn't surprise me if people start to actually emphasize small caps as a bigger part of their portfolios relative to things like NASDAQ, which has been, sucking most of the liquidity of equity markets and other parts of the asset classes. Let's go to the next chart. And so, next chart again. Go back. This is actually just looking at NASDAQ, another ratio versus commodities. I had this chart in the prior presentation. I thought I should have it again in this one. And you can see here the opportunity to me, and the reason why the opportunity is really pronounced in hard assets is on commodities, is on hard assets, and real assets are really the things that are really cheap today relative to money supply, once again, relative to NASDAQ, relative to their own valuations throughout history. Kevin showed a chart of silver and cocoa, and that's such an important a chart, because we know that the structural problems in the commodity industries have not been fixed, meaning we're not seeing a flood of capital coming to the space that is causing the miners and other agricultural commodity companies really enjoy and appreciate that level of capital inflows to really redeploy that capital into new supply. And so this is creating, to me, one of the best scenarios for a long-standing bull market for commodities that is probably going to be driven not only by the demand side that we can talk about, but also the fact that supply is likely to be very constrained moving forward. Now, one thing that a lot of people do, and that's usually what happens in a very speculative environment. This chart is going to be a funny chart, but at the same time, an important one. Let's go to the next one. And now look at this chart real quick. If something looks like a duck and walks like a duck and quacks like a duck, then it might be a duck. And this is a funny chart looking at NASDAQ 3 times leverage ETF versus Bitcoin. Now, I have nothing against Bitcoin personally. Now, I do think that calling it a digital gold, a version of a hard asset like gold, I think that's not the right analogy at all, or comparison, I should say. I think that there are better comparisons. Maybe this is the NASDAQ 3 times leverage idea. Let's call it by the more proper name rather than digital gold. Digital gold is something that I think it's kind of misleading, number one. And number two, I also don't think that this idea that gold has been making new highs is really overvalued at all. I've been, I was in an interview the other day, and this guy was asking me, he really wanted to know, is gold ahead of itself today? I couldn't have a much, I have such a strong opinion about that topic, because I think that gold relative to almost anything today is extremely cheap. It's relative to money supply, to S&P 500, to NASDAQ, to GDP. I mean, literally all sorts of things relative to gold really looked historically depressed. Bitcoin is certainly not at the same level that I know of, and maybe this banana republic environment is very positive for Bitcoin. We'll continue to see Bitcoin moving higher, and Nasdaq continues to see multiples that are. But I do think gravity ultimately works at some point, and if those things are linked, especially on days like today, pay attention to days like today in which we're seeing a big decline in equity markets, driven by technology, mega cap companies. Bitcoin is also down, along with Nasdaq, three times the leverage ETF, and the Nasdaq, the actual normal Nasdaq 100 index is also down close to 2%. So again, this is nothing against Bitcoin, but I do think that there's a lot of misleading ways that people are using to describe what Bitcoin really is, and to me, it's just speculation times 3. Let's go to the next chart. So another narrative that I think it's important to maybe describe here is what's happening with the Fed, and is the Fed turning more dovish, and what are the reasons behind that? I think actually Novogratz put out a good tweet, which was bullish for Bitcoin, according to him. He claimed that essentially there are no reasons why the Fed should be cutting interest rates. I agree 100% with his idea. I think if you looked at the data itself, there are no reasons why the Fed should be cutting interest rates. I'll go through a few charts of why inflation is actually reaccelerating. If that's the case, and the Fed is actually forced to start cutting interest rates for whatever reason it is, I've been thinking a lot about it. What are the potential reasons? And maybe this chart right here is the main reason. Now, we can talk about the political potential ways to explain that type of change in stance. But I think it has to do with what's happening with the debt service problem that the economy is facing. And when you look at the interest payments that we're seeing, with interest rates staying where they are, we're probably going to see actually interest payments run up to about $1.6 trillion, as is shown in this chart in the blue line that continues, the lighter blue line that continues. And if you see the projection that if the Fed cuts interest rates by about 150 basis points, we're going to go to actually $1.2 trillion. And so it's a 30% gap between the two. So that to me is probably the main reason why the Fed is actually being forced to cut interest rates. I think it's highly possible that by cutting interest rates is probably the only way to continue to survive in this environment. I don't think the government is going to be able to run a primary budget surplus anytime soon, given what's happening with the fiscal dominance and the reshoring and the green revolution and all sorts of, and even defense spending that hasn't even started to really come in like we saw back in the 40s and 70s and 60s. And so as we see those things really play a role into the government spending, this is going to become very problematic to run a potential surplus in the primary budget. And so potentially what we may see is actually the Fed having to lower interest rates on the short end, because that's where they have the power to really manipulate markets on the short end. And by doing that, potentially having a much larger percentage of the composition of the U.S. debt, federal debt, being driven by T-bills, in which are linked to the short-term rates that the Fed has a handle over. And so to me, that's really what's the scenario going to look like. This is, to me, it's an explosive environment for hard assets, is as good as it gets. It's better than the prior 3 decades that we've had, not the prior 3 decades, but the 3 decades that we had in the past that were inflationary eras. The 1910s, the 1940s, and the 1970s were nowhere close to this lack of discipline from a fiscal and monetary environment that we're in. And to me, this is going to drive even further this commodity markets and other real assets. And by the way, that's not to mention what's been happening, in the micro side of that I mentioned before as well, of the chronic underinvestments in commodities that is likely to also keep the supply very constrained, and also the demand surging from this, what I'm proposing here with suggesting that it's going to be a very inflationary environment for the long term. Let's go to the next chart. And so Bank of America also had this chart, and I remember looking at this chart of actually by the CBO, and I had a chart here in this presentation basically showing their guidance of how much, or estimates of how much the debt is, a federal debt would be. And if I'm right, it was basically they're expecting that we would reach to $40 trillion back in 2030s and 2040s or so. This chart is basically showing we're going to be at $40 trillion by the second half of 2025. That's such an important thing to think about. As I presented in the prior live presentation on Friday, I think that the main reason why 10-year yields are going up is really supply driven. If it was inflation driven, you would see break-evens a lot higher. I think break-evens are likely to go a lot higher, but it's not yet a big driver of 10-year yields. It's not really foreign central banks selling treasuries, because actually foreign holdings of treasuries are at record levels today. And to me, what's really coming down to, and it's also not default risk, because CDS and credit default swaps and all sorts of things relative to 10-year yields are also not explaining this movement on the upside. I think that's really on the screen what it is. It's the flood of issuances. Let's go to the next chart. One concept that I think it's important as well is, as we see the government kind of having to work towards the situation that is highly inflationary, we have to think about that the government will likely come in with different types of subsidies in different segments of the economy. And what is important to think about this chart, which is breaking down, over decades, the inflation among different things, daycare or you can look at the school expenses, or schooling expenses, or college expenses, I should say, or medical expenses. Most of the things that the government receives, that most of the items that actually receive government subsidies have experienced even faster inflation than the ones that are more independent. This is such an important aspect, because we're likely to see so many things that the government will probably get involved. That is probably going to be driving even further inflation to the upside. Let's go to the next chart. And so commodities are, I posted this chart recently, commodities are probably into a second wave of inflation. I think that's the case here. We've had a first wave back in 2021, and then that peaked back when Russia invaded in Ukraine. And now we're experiencing a second wave. A lot of people are thinking this is unique. And I actually think Kevin had a very good point the other day in one of our calls, internal calls. He said this is very similar to back in 2021, not from a wave perspective, but how the Fed is behaving, and calling this, again, maybe this is, again, transitory. And it's, in our view, it's certainly not. I mean, it's a structural, it's got lags, it's got many pillars of inflation. And it's certainly, to us, it looks like it's a long-term problem. Let's go to the next chart. And so here's another thing that is also interesting, is that even from a positioning perspective, as we look at positioning for trading and other aspects of investing, we're not seeing that investors are crowded in positioning when it comes to commodities. This chart, that's kind of what it's showing. It's, despite the fact we're seeing the second wave, the positioning remains very low relative to its history. Let's go to the next chart. And so you can see even ag prices are starting to show a second wave. First wave started in 2021. Now we're seeing the second wave here and being unleashed. Now, I think it's just the beginning. Let's go to the next chart. This is the 10-year break-evens. And when I say that 10 years break-evens have a lot more to go, is because we, if you looked at this chart, we just broke out on a weekly basis, on a weekly candle. And I think there's so much more for this to move to the upside and to retest the levels of 2021. Clearly, we've been in the last 3 months or so in an upward trend. The Fed seems to be ignoring this. And again, I don't think they're actually ignoring. I should rephrase what I just said. I think that the big focus is on the debt servicing problem that they don't want to mention. In fact, the main change in the Fed minutes recently was the fact that they might actually reduce the amount of QT. In other words, they're trying to improve the demand aspect of treasuries, because by not rebuying those treasuries, that they are allowing them to run off and depleting those reserves over time, it's causing or I should say, it's adding to the problem of the supply issue with lower demand and driving yields higher. Let's go to the next chart. And so you can see oil, it's been a story that we've been covering here recently. Oil is, we had a few charts. Kevin pointed out the seasonality of energy and how energy is starting to look good. Oil companies score really well in our own models too, equity models that we run here at Crescat. And it's really interesting that so many people used to be bullish in oil a year or two ago, and now all those folks are gone. And now recently we have seen a little bit of a change given the fact that oil prices begin to break out and people are starting to see the trend. But this is actually ahead of the break evens and usually has a very strong correlation. So if oil continues to break out, which we think it will, for two reasons, and I'll point out in a minute, we think also break evens and inflation expectations are going to follow. Let's go to those two reasons real quick. One of them, gasoline prices also broke out. I'm not going to go through that, but basically very similar chart. It broke out recently. Probably it's going to go a lot higher, but let's go to the next chart. You can see here one of the reasons is inventory shortages are yet to drive the prices of oil a lot higher. And so you're looking at two lines in this case. You're looking at the inverted inventories of oil in the US, and the white line is just the WTI prices. And so you can see clearly that there's a correlation between the two, where when inventories run low, you tend to see oil prices go higher. And now recently there is a big gap between the two, in which is driven by many things, one of them being SPRs and other things such as just drawing the inventories over the last month or so. But certainly there's a gap in which we think it's a bullish gap for the white line to catch up with the red line. As we see that happening, it could be driving oil prices back to the levels that we saw during the Russian invasion period at $130 a barrel or so. Let's go to the next chart. The second reason is because Saudi Arabia is now running one of its highest break-even prices in nearly 2 decades, as you can see in this chart. And that's mostly because we're accounting for the current account break-even that they call, which is basically looking at how much they've been spending on things in general to build up their economy. And therefore, the cost of that is starting to reflect on the cost to produce oil as well. And how much will they have to make in order to accommodate things like increasing production of oil. And so the break-even rate of Saudi Arabia has been in an upside, and that is another thing that is likely to drive the oil price much higher. Let's go to the next chart. So now let's run into precious metals and finish the presentation so we can get Quentin in here as soon as possible. But basically, here is a chart that I've been asked the question as well of do you think this is like I said, is the gold market really ahead of itself? There are important things that you can look at as a trader. We like to look at, and we're not traders, we're investors, but as a trader, I think a trader often looks at things such as positioning and overbought and oversold indicators. Now, I want to point out how different this environment is relative to those things. Who's buying probably gold is likely to be central banks. How do we know that? Well, we presented that case before. It's basically looking at the GLD ETF, assets under management. We're not seeing that increase along with the gold prices increase. Therefore, it's not coming from the general investor. It's coming from a larger institution that is driving the prices much higher from an accumulation standpoint. And so that brings to my mind is that positioning among general investors are not really driving the price, and therefore the overbought indicators that we often like to see are probably not as relevant, because when we looked at positioning itself, positioning is not extreme at all. We can look at positioning across CFTC data, looking at the future markets through their contracts, and we don't see at all that the future contracts are at all-time highs in terms of positioning. It's more like it's a historical average over the last 2 decades. So that's number one. We're not seeing gold miners have a big run up yet. Now, we think it will happen. But if you looked at gold miners, central banks don't buy gold miners. They buy gold. Therefore, we're seeing that lagging effect across most of the miners, in which we think it's a major opportunity. And so those are the important aspects going on across the gold space. And the other thing I would point out is the fact that how cheap things are. I mean, just look at silver. We're seeing a big reversal in silver prices today. That is not, to me, the big attention here. The big thing is the opportunity on the long-term opportunity that we have in front of us. And the long-term opportunity is presented very well in this chart. Is silver relative to money supply or adjusted to money supply is just now potentially forming a double bottom. And we think there's so much more upside for the metal. We know that it's been breaking out recently from major historical resistances not too long ago, and we think that the upside is just getting started. So for us, the opportunity really is in gold, but silver even more, and potentially even more in the miners. So let's go to the next chart. So you can see here that gold prices have been rising, but when you look at the GDX ETF, how much assets under management it has in the blue line, it's historically, if gold prices keep going higher, and if this is indeed the beginning of a bull market for gold, I think that the blue line is going to be one of the best ways to play this, and that's really we're yet to see that influx of capital from general investors into the mining industry as they start realizing that the economics of those miners have drastically changed with the fact that metal prices are much higher. And that's that doesn't happen on one day. It's a process. People are still understanding this is one of the most hated industries. I think this is the most hated industry in the world today. And if that's really the case, there's so much room for a change of views from investors. And as we see that happening, it should drive the blue line much higher. Let's go to the next chart. And so you can see junior miners. I made a point about, if central banks are really going to be turning dovish in an environment where inflation is clearly accelerating again, none of us own enough hard assets. That's just an opinion, obviously. And I do think of that in terms of junior miners, because junior miners have not moved at all yet. I mean, I think we can easily see large returns in the near future. And so I'm really focused on this because, again, this is all my opinions. I'm backed by historical data of looking at when we see a big run-ups in gold prices, usually for logical and rational purposes, gold miners tend to do very well. And, the main part of the central thesis here is, are we in an inflationary era? And is this really a beginning of a secular bull market for gold? I think there are many reasons why we believe that that's the case. And if so, I think this chart is not only at the beginning of a breakout, but it's probably going to go much higher. Again, just our views on this. Let's go to the next chart. And you can see that not just from my perspective, but looking at the data, macro data of places like India that have a very good history of owning precious metals. I know gold is a bigger taste for Indians relative to silver, but we're seeing large amounts of silver imports in India recently, and this data is looking at US dollar terms. And it's remarkable what we're seeing in terms of accumulation of silver by India. And it's probably another important driver of the recent run-up in prices too. Let's go to the next chart. I'm almost done. I think it might be my last chart. If not, there's a few two charts or so. But this is such an important reminder of the case. Just a simple way to explain the demand case for silver, which we get asked so many times. Silver is an inflationary asset. People have forgotten that silver used to be a monetary metal, and it still is. Although it's an industrial metal or a monetary metal with industrial properties, it does have its also properties from a monetary perspective. It used to be used as a currency in the past, and certainly it should be seen as a monetary metal today. And we know that it's historically undervalued just by analyzing silver prices relative to money supply. And lastly, what's been potentially another driver that didn't used to be the case is watching what's happening with the green revolution, in which is using more and more of the metal over time. And as we see the breakouts in copper and other things that are linked to the green, even more linked to the green revolution, it should also drive the prices of silver that is still really undervalued, even relative to gold prices itself. And then if we go to the next chart, there's a new aspect going on, which is, and I'll tie this up and finish, but utilities are now saying that they're bracing for a surge of power in demand. How do you think AI, artificial intelligence, and all those technology advancements are going to be able to be as useful as people are expecting without using a massive amount of electricity over the years. And even Elon Musk actually pointed out the risk for shortages of electricity in the future, driven by three things, really. The demand for electric vehicles, what we're seeing in terms of the AI revolution, but also even from a heating perspective that we're seeing, places like New York forcing people to actually move away from gas stoves to actually electrical ones, and all those changes are going to be big drivers for electricity demand, as we see this need for revamping across most utility companies. I think that's also going to be a big driver of metals. In fact, if we go to the next chart, if you read our last letter, we talked about this construction boom, which is happening already. But also we put out, different ways of measuring that today relative to history, in which we show that certainly what we're seeing currently is a surge of infrastructure developments and construction, mostly driven by the government, and how much they've been, with the Inflation Reduction Act, the Infrastructure Act, and so forth, are completely dwarf other periods in history, such as the rebuild of the World War II that we saw globally. Even inflation numbers in US dollar terms of today, the numbers we're seeing are really astonishing. And the white line here is just showing the CapEx trend that we know that is historically depressed. And so which one is going to give? And the next chart is the very last one. That is the final way of thinking about this. How do we go from all these policies without making the metals and mining industry at least not a margin error relative to the size of the S&P 500, in which we're seeing today a 0.4% weight of the metals and mining industry in the S&P. Even if you go back in prior decades, we're just going back to the early 2000s in this chart. But if you go back to prior decades, we used to be double digits in terms of the weight of the metals and mining industry. And I really think we're going to go back to that.